Right now, while most Americans are worried about their grocery bills, their mortgage payments, and whether the Fed is going to cut rates anytime soon, something far bigger is quietly building beneath the surface of the global economy. And when it finally arrives at your doorstep, it won't knock politely, it will kick the door down. Oil is about to become one of the most disruptive financial forces in America in over a decade. And the painful truth is, most people have no idea it's coming. We're talking about a shock that could spike your energy bills, reignite inflation just when the Federal Reserve thought it had things under control, hammer your 401k, slow down GDP growth, and squeeze every working American from the gas pump all the way to the supermarket checkout line. And the worst part, the warning signs have been flashing for months. So if you have a job, a retirement account, a car, or a house, and that's basically all of us, you need to understand exactly what's unfolding, why it's happening, and most importantly, what you can do about it before the wave hits the shore. Let's start with the basics. Because the term oil shock gets thrown around a lot, but very few people actually understand what it means in real financial terms for everyday Americans. An oil shock is not just about gas prices going up a few cents at the pump. It's a rapid, sustained increase in the price of crude oil that ripples through the entire economy with a force that touches virtually every sector. Manufacturing, transportation, agriculture, housing, retail, and yes, your personal finances. When the price of a barrel of oil surges, it doesn't stay contained to the energy sector. It bleeds into the cost of producing goods, the cost of shipping those goods, the cost of heating and cooling homes, and ultimately the cost of everything you buy. Think about it this way. Oil is not just fuel. It's an input cost embedded in nearly every product in the American economy. From the plastic packaging around your groceries, to the fertilizer that grows your food, to the asphalt on the highway you drive to work. Historically, oil shocks have been the hidden hand behind some of the worst economic downturns America has ever faced. The 1973 OPEC oil embargo sent the U.S. economy into stagflation, that toxic combination of rising prices and stagnant growth that the Federal Reserve absolutely dreads. The 1979 energy crisis triggered another brutal recession. Even the oil price spike of 2008 played a significant role in stressing consumer finances, right before the housing collapse. And right now, in 2024 and beyond, the stars are aligning for another one of these events. Fueled by a combination of geopolitical instability, OPEC production decisions, a weakening dollar, and a structural underinvestment in global oil supply that most financial media outlets are barely covering. So let's break down exactly what is driving this situation and why America is particularly vulnerable. The first major force driving us toward an oil shock is OPEC+. Specifically, the decision by Saudi Arabia and Russia to extend and deepen their production cuts. Saudi Arabia, acting as the de facto central bank of global oil supply, has been deliberately keeping barrels off the market in order to prop up prices and rebuild their own fiscal revenues. Russia, squeezed by Western sanctions following the invasion of Ukraine, has similarly found it advantageous to keep supply tight, so that every barrel they do sell fetches a higher price. What this means in practical terms is that the world's two largest oil exporters are effectively running a cartel strategy that prioritizes their national budgets over global economic stability. And America is on the receiving end of that decision every single time someone fills up their tank. The second force is structural underinvestment in oil production. After the pandemic collapse in 2020, when oil briefly went negative, a moment so surreal that traders were actually paying people to take oil off their hands, major energy companies slashed their capital expenditure budgets dramatically. They were burned badly, and their shareholders demanded discipline, dividends, and share buybacks, rather than risky new exploration. The result is that the global oil industry has spent the last several years not building the additional capacity that the world needs now that demand has recovered. You can't just flip a switch and start pumping oil from wells that were never drilled. The lag time between capital investment and actual production is measured in years, not months. And that lag is now coming due in the worst possible way. The third force is the geopolitical premium baked into every barrel. The Middle East remains a powder keg, and every escalation in that region sends crude prices higher. Tensions in the Red Sea shipping lanes have already disrupted global trade routes. Any broadening of conflict in the region could take significant portions of global supply offline, overnight. Markets price in that risk, and the risk right now is higher than it has been in many years. Adding to this is the dollar dynamic. Oil is priced globally in US dollars, and when the dollar weakens, which tends to happen when the Federal Reserve pivots toward rate cuts, it makes oil more expensive in relative terms, even before any supply disruption occurs. The Fed is caught in a vice: cut rates to support the economy and risk a weaker dollar that makes oil more expensive. Keep rates high and choke off growth. Either way, Americans lose. Now let's get specific about how this hits the average American household, because this is where it gets very real very fast. The most immediate and visible impact is at the gas pump. When oil prices rise sharply, gas prices follow within days, sometimes within hours. For a household driving 2 cars and covering the average American mileage, a sustained spike in gas prices is effectively a tax increase that Congress never voted on and the IRS never administered. It just shows up automatically every time you stop for fuel. And unlike a tax, this one doesn't fund schools or roads. It funds the sovereign wealth funds of Gulf states and the Russian war machine. But gas is just the beginning. The second wave of impact comes through what economists call pass-through inflation, and this is the one that really does long-term damage to your purchasing power. When fuel costs rise for trucking companies, airlines, manufacturers, and farmers, those costs get passed through to the end consumer in the form of higher prices on everything from food to clothing to electronics. We saw exactly this dynamic play out in 2021 and 2022, when a combination of supply chain disruptions and energy price spikes drove the consumer price index to levels America hadn't seen in 40 years. That spike destroyed real wages for millions of Americans, eroded the value of savings accounts, and forced families to lean harder on credit cards, a trend that has not fully reversed. If oil prices surge again, all of that pain gets recycled through the economy one more time, and the Federal Reserve will have a serious problem on its hands. Because here's the bind the Fed is in right now. After 2 years of aggressive rate hikes that pushed the federal funds rate to its highest level in over 2 decades, the central bank has been looking for a window to begin cutting rates and providing relief to a housing market where 30-year fixed mortgage rates are strangling first-time homebuyers, and to businesses carrying expensive variable-rate debt. But if oil prices spike and inflation reaccelerates, cutting rates becomes politically and mathematically impossible. The Fed's dual mandate, price stability and maximum employment, turns into a direct conflict. You can't simultaneously fight inflation and stimulate growth, when an external commodity shock is doing the dirty work of both, destroying purchasing power and slowing the economy at the same time. That's the definition of stagflation, and it is the nightmare scenario that Fed Chair Jerome Powell has been hoping to avoid. If the macro picture seems grim, let's talk about what an oil shock does to your investment portfolio and your retirement savings. Because for the millions of Americans with 401k plans, IRAs, and brokerage accounts, the financial damage can compound quickly and quietly in ways you might not notice, until you open your quarterly statement and feel your stomach drop. The stock market hates oil shocks for several reasons. Higher energy costs compress corporate profit margins across the board. Airlines, retailers, manufacturers, logistics companies, and consumer goods firms all see their cost structures blow up when oil surges. Investors anticipate this margin compression and sell equities, which pushes prices down. At the same time, if the oil shock is severe enough to revive inflation concerns, the bond market starts pricing in higher interest rates for longer, which is toxic for growth stocks and tech valuations because those stocks are priced on discounted future earnings. And when discount rates rise, those future earnings are worth less today. The result is that your typical diversified 401k, loaded with broad index funds, can take a meaningful hit from an oil shock, even if you're not holding a single share of an energy company. There are sectors of the market that do benefit, of course. Traditional energy stocks, companies like ExxonMobil, Chevron, and other upstream oil producers, tend to rally sharply when crude prices rise, because their revenues are directly tied to the price of the commodity they produce. Energy ETFs and master limited partnerships in the midstream sector can also provide exposure to rising oil prices. Some financial advisors will tell clients to rebalance their portfolios to include a larger energy allocation as a hedge. That is a legitimate strategy. And historically speaking, Having 5 to 10% of your portfolio in commodities or energy equities has served as a useful inflation hedge during periods of oil price stress. But it's important to understand the volatility involved, and you should always consult your financial advisor before making significant changes to your asset allocation. Because what works as a macro hedge doesn't always work for your specific financial situation, your timeline, or your risk tolerance. Real estate is another asset class with a complicated relationship with oil shocks. On one hand, inflation tends to support nominal home prices. And homeowners who have locked in low fixed-rate mortgages from 2020 and 2021 are sitting on real assets that tend to hold their purchasing power better than cash during inflationary periods. On the other hand, an oil shock that drives inflation higher and keeps mortgage rates elevated is terrible for housing affordability and for anyone trying to buy or sell in the current environment. The housing market is already under severe stress from the rate environment, and another round of energy-driven inflation could push it from stressed to broken. So after all of that, let's talk about the part that actually matters most. What can an ordinary American do to protect themselves, and even potentially position themselves, to come out the other side of this in better financial shape? Because as dire as the picture looks, history tells us that oil shocks, like all economic disruptions, are survivable and even profitable for those who are informed and prepared. The first thing you should do is conduct an honest audit of your personal energy exposure. How much of your monthly budget is going toward gasoline, home heating, and electricity? If that number is high and you have the means to reduce it, whether through a more fuel-efficient vehicle, better home insulation, a programmable thermostat, or even a modest investment in solar, doing so now before prices spike is a form of financial self-defense. Lowering your energy dependency doesn't just save you money in a normal environment, it creates a powerful buffer when prices surge. The second thing is to look hard at your debt situation. An oil shock that revives inflation gives the Federal Reserve every reason to keep interest rates higher for longer. Which means variable rate debt, credit cards, adjustable rate mortgages, home equity lines of credit becomes increasingly punishing. If you're carrying high-interest credit card balances, the debt avalanche method, paying off your highest APR balances first, while making minimum payments on the rest, is your most efficient path to reducing that vulnerability. Your FICO score is also worth protecting right now. Because if refinancing opportunities arise later in a rate cut cycle, you want to be positioned to take advantage of them with a strong credit profile. The third thing is to revisit your emergency fund. Most financial planning frameworks recommend 3 to 6 months of living expenses in liquid, accessible savings. A high-yield savings account at an FDIC-insured bank is the right vehicle for this, in the current rate environment. An oil shock that slows economic growth can translate into layoffs, reduced hours, and business closures. Having that cushion means you are not forced to liquidate your 401k, which would trigger income taxes and a 10% early withdrawal penalty from the IRS, just to cover a bad stretch of months. Here is the bottom line. America is not helpless in the face of an oil shock, but it is vulnerable. More vulnerable than our political leaders care to admit, and more vulnerable than most financial commentators are telling you. The combination of geopolitical risk, OPEC discipline, structural underinvestment in supply, and a Federal Reserve that is already walking a tightrope between inflation and recession creates the conditions for a genuine economic disruption. The Americans who come through this in the strongest position will be the ones who understood what was happening before it fully arrived, who reduced their energy exposure, cleaned up their balance sheets, protected their retirement savings, and made informed, deliberate decisions rather than panicked, reactive ones. That is exactly why channels like this one exist, not to frighten you but to equip you. Because in finance, as in life, the most dangerous thing is not the crisis itself. The most dangerous thing is being unprepared for it. Do the work now, make the adjustments now. And when the oil shock does hit America, and the evidence strongly suggests it will, you will be one of the few people who can look at it calmly and say, "I saw this coming and I was ready."